So in this problem, Peachtree Corporation has no accumulated or current earnings and profits through December 31st of the current year. On December 31st, Peachtree distributes to Grape, its sole shareholder, a parcel of land with a basis of $90,000 and a fair market value of $190,000, subject to a mortgage of $140,000, which Grape is going to assume. Now, Grape's basis in the stock of Peachtree Corporation is $50,000. Okay, so looking at this problem, here now, Grape is receiving a parcel of land that has a liability on it, subject to a mortgage. It's subject to a mortgage which Grape is going to assume. Grape assumes that mortgage. So that's extremely important to understand this problem. So anytime we have a distribution, remember, distribution in the tax law is not the same definition as a dividend. A distribution might be a dividend, but it also might not, depending on the facts and circumstances. The first step, step one, is to look at the tax consequences of the corporation. Now, when it comes to the tax consequences of the corporation, whenever there's a cash distribution, step one is not going to have any consequences. However, when there's a property distribution like we have here, which property other than cash distribution like land, we're going to take the amount realized minus the adjusted basis of that piece of property, and that gain but never loss must be recognized. So you're wondering, okay, well, you might have seen my previous videos where we talk about the amount realized is the actual cash received plus constructive cash received plus fair market value of non-cash property received minus selling expenses. Well, here, Peachtree Corporation is distributing property, and there's nothing to do with any of those items. So you're asking, well, what exactly is the amount realized? Well, Section 311 of the Internal Revenue Code basically states that the amount realized here is going to be the fair market value of that property. So here, the fair market value of the land at the date of distribution is $190,000. So we use $190,000 as the amount realized minus the adjusted basis of the property at the date of distribution, which here is $90,000. So we subtract away the adjusted basis of $90,000. And this gives us a gain, a realized and recognized gain by the corporation of $100,000. So on Peachtree Corporation's 1120, $100,000 gain must be recognized. Now, if this was a loss here, the loss would be realized but not recognized. Section 311 says that gains must be recognized, but losses never can be recognized. Okay? Losses can never be recognized in this situation. So we've just done step one. Peachtree Corporation has a $100,000 gain that must be recognized on the Form 1120. Okay, so now we go to step two. Once we've determined step one, step two is to adjust the current E&P for the year by step one. By step one. Okay. So here, the current E&P given to us in the problem is actually zero. We're told in the first line that Peachtree Corporation has no accumulated or current earnings and profits through December 31st, the current year. So current E&P will be zero. What we do is we add this gain to current earnings and profits. So we add this $100,000 gain that we've just recorded, because remember, this goes on the tax return, to give us our step two adjusted current E&P of $100,000. So that is how we calculate the current E&P as a result of step two to use for purposes of step 3 and 4. Now, I want to note something. You might be wondering, okay, well, why exactly are we doing this? again, the corporation is going to have to report this $100,000 gain on the Form 1120. And remember, the whole idea of earnings and profits is you're looking at financial accounting. And you're right, the financial accounting idea. So that's going to increase the current E&P given to us as a result of the end of the year. But remember, we're also adjusting for this economic gain. So that's going to increase earnings and profits for the year, current earnings and profits for the year. Now, you might be wondering, but don't gains also create a tax amount? And you're right, they do. Now, we're going to assume, we're not going to worry about the tax consequences in this problem, but really in practice, you would have to net the amounts, the gain of the taxes they create. So if the corporate tax rate is 21% on this gain, you would actually have a $21,000 tax effect. So you'd actually have a $79,000 adjustment, $100,000 minus $21,000, a $79,000 adjustment to current earnings and profits. Now, I'm not going to adjust for that to make it more simple so you understand exactly how this rolls over so you see how it works. So we're pretty much going to ignore tax consequences, but in practice, you would have to adjust the net effect of the tax. Okay, so now we've done step 1 and 2. Again, we have a gain here. And by the way, this gain, the character of this gain is going to be whatever the land is. So this land looks like it's business land. And if it's held for more than a year, it's going to be section 1231 gain, just so you know. Then the current earnings and profits is adjusted by 100,000. So step 3, following along with our checklist, step 3 is we look at the consequences to the shareholder. So the shareholder here is grape. That's why I use the purple color, because the grape. So the shareholder consequences, okay? And remember, when we do the shareholder consequences, we always follow the 3-part waterfall. First, we're going to look at the dividend to the extent of earnings and profits. Second, anything beyond that is considered return of capital to the extent of basis, which the basis here is given as $50,000. And finally, third, we're going to have capital gain distribution for the rest. Now, before we determine that 3-part waterfall, we have to determine the amount of the distribution. So the distribution equals the amount of cash received plus the fair market value of any non-cash property received minus any liabilities assumed. So here, is Grape receiving any actual cash? No. Grape receives a parcel of land. So we do have fair market value of non-cash property. That's the $190,000. I'll just put $190K. But that land is subject to a $140,000 liability. So we subtract that away. Remember, we subtract away liabilities. So $190,000 fair market value minus the $140,000 liability amount that's on that gives us a distribution amount of $50,000. Okay, that $50,000 distribution amount, we're going to go ahead and apply our waterfall. So the first stop on the waterfall is dividend. It's a dividend to the extent of total E&P. So here we have no accumulated E&P. So that makes that part easy. Current E&P was 0 at the beginning of the problem, but look at this. We use this $100,000 current E&P. Again, we would have to adjust for tax, but to show you how everything flows in this problem, we're going to ignore tax for this problem. So this $100,000 E&P goes here. Again, that's why we do this in order, the steps. So we have total E&P as a result, or as of step 3 of $100,000. So the $50,000 distribution is all dividend because we have enough E&P to cover that. So that means that step 2, our return of capital, as I call it, the ROC, return of capital, right, which isn't taxable, is 0. And finally, step 3, our capital gain distribution, is also going to be 0. So that gives us the consequences of the shareholder. We have a $50,000 dividend, and that's how it's going to be taxed. Goes in the Form 1099 DIV in that sense. Reported as a $50,000 dividend. Another thing that when you look at the shareholder consequences, remember, Grape is receiving land here. So the question is, what is the basis that Grape takes in that land? And remember, the rule is under section 301D that it's always going to be equal to the fair market value. So the fair market value here is $190,000. So that is going to be the adjusted basis of the land that Grape takes by Grape. The $190,000, the adjusted basis of the land in Grape's hands. So we've just determined how the $50,000 distribution is taxed as a dividend, and we also determined the basis of the land going forward to Grape.